UNLV Microcertificate Economics. Today's topic is going to be international economics. Some terms we need to know. When you hear the word export or you hear the word import, you're thinking stuff. You're thinking oranges got sold to Japan. That's not the right way to think about it. An export, just think about it as any transaction that brings money into the country. If money's coming into the U.S., that's an export for the U.S. If money's going out of a country, that's an import. When we sell oranges to Japan, money leaves Japan and comes to the U.S. That means export for the U.S., import for Japan. When people get on a British Airways jet in the morning and fly to Las Vegas, money is leaving England and coming into Las Vegas, which means that England has an import and the U.S. has an export. Las Vegas is an exporter. Money comes into the U.S. in Las Vegas, just as if we were selling oranges to England. But we don't have oranges. We have hotel rooms, which we sell to people in England. We measure these transactions in an accounting system called the balance of payments. It's an accounting system. Now, there are two basic parts to how we account internationally. One is called the International Transactions Accounts, the ITA. That's the traditional balance of payments. We also have something called the International Investment Position of the United States. That's the IIP. In this class, we're not talking about the IIP. When you get to finance, you can talk about that. We're going to talk about the basic international transactions accounts. So, in the ITA, there's a whole bunch of accounts. There used to be just two. Now there's a whole bunch of accounts. The first of these accounts is called the current account. We'll talk about what's in each of these accounts in a minute. The second of these accounts is a set of accounts called the capital and financial accounts. There used to be a capital and financial account. Now there are the capital and financial accounts. And then it turns out that these things are supposed to add up to zero. The current account plus the capital and financial accounts should add up to zero. They don't. So we balance them out by just adding a number into them, and we call that number statistical discrepancy. It's kind of like you get to the end of the month, your bank says to you, hey, you're short $10, and you just write on the statement plus $10 statistical discrepancy and send it back to them. So what's in the current account? The current account is imports and exports of goods and services. So that tourist who came to Las Vegas is in the current account. When we sell oranges to Japan, that's in the current account. Imports and exports of goods and services. It also contains primary and secondary income. Primary income is person is paid, it's job related. A person is paid for their job by somebody in another country. So you work for Las Vegas Sands in Macau. You work in Macau, you work in China, but your paycheck comes to you from Las Vegas. That's primary income. Secondary income is I stick $10 in an envelope and send it to a relative who lives in another country. That happens all the time. Right? People who live in the United States send money to relatives in other countries or vice versa. And then lastly, government transactions are in the current account. So there's a tsunami in Indonesia. We send the Navy to help out. That costs us money. That money shows up in the current account. We send the Army to help fight the Ebola outbreak in West Africa. That money shows up in the current account. The capital account is all about licenses and intellectual property. So the current account is the value of copyrights, patents, movie stuff. If you buy a copy of Harry Potter, money has to go back to England to J.K. Rowling. That money is in the capital account. If A company in China licenses U.S. technology to use in the production of goods. That shows up in the capital account. They built a factory with our tech. Often they don't pay us when they build a factory with our tech, and that's a big problem. The financial accounts are about assets. So part one is foreign-owned assets in the U.S. Part two is U.S.-owned assets in other countries. When Fiat buys Chrysler, Chrysler becomes a foreign-owned asset in the U.S. When someone from China buys a condo on the Las Vegas Strip, that's a foreign-owned asset in the U.S. When a U.S. person buys a vacation home in France, that's a U.S.-owned asset in another country. When we buy a company in another country, when Ford bought Volvo originally, Volvo became a U.S.-owned asset in another country. The change in those, the amount of money that flows back and forth because of those, shows up in the financial accounts. The interesting part of this is, of course, that these things have to balance. So somehow, and we'll talk about this when you actually show up in class, but somehow what we buy from other countries gets paid for by our assets and vice versa. So here's the 2017 U.S. balance of payments. You'll notice that we had a big minus on our current account. That means we bought more from other countries than they bought from us. We balance that out by a plus on the capital financial accounts, which essentially means we go into debt to pay for the current account deficit. So we have a deficit on our current account, minus 451. We have a plus 377 on the capital financial accounts. That means we either borrowed money or sold our assets to effectively pay for the current account. But you notice those two things didn't quite add up right, and so we had a statistical discrepancy of $74 billion, and the whole thing adds up to zero, just like it's supposed to. Okay, so when we want to buy or sell something from another country, it's not as simple as just going to the store and buying it. Stores in Japan don't really want to take dollars, they want to take yen, and so we have to convert our currency to their currency, or the tourists coming here have to convert pounds or euros to dollars. There's a price of one good in another, or one currency in another, and that's called an exchange rate. So, and these are past exchange rates. You can see the exchange rates in the modern world change by the millisecond. So if you go look at the exchange rate now, these aren't them, but it might be that $1 equals 115 yen, or in other words, a yen equals about a penny. It's $1 equals 6.8 yuan renminbi, which is the Chinese currency. And $1 equals 0.93 euros, about $1 per euro. How do these exchange rates happen? Well, in the modern world, exchange rates are supposed to happen because they float. Floating means exchange rates are set by the market. In our world, they don't actually float the way they're supposed to most of the time. And because of that, we say that they're managed exchange rates. And we'll talk about that more in class. But basically, a floating exchange rate is an exchange rate set by the market. If the government sets that exchange rate, we used to say that it was fixed. We don't like that fixed word anymore for some reason. In the modern world, we talk about pegged exchange rates. China pegs its exchange rate to the dollar. We used to say it fixes it. Now we say it pegs it. The government sets it. Why do they go up and down in the market? Well, scarcity. If foreigners are taking dollars out of the market, there's fewer and fewer dollars in the market, it becomes scarce, its price goes up. Instead, what we're doing most of the time is we're putting dollars into the market so that we can buy stuff from China, say. That makes the dollar plentiful. It makes the yuan scarce. The plentiful dollar should fall in value and the scarce yuan should rise. Exports increase the value of your money, of your currency, and imports lower the value of your currency. Unless, of course, the country is pegging it, and we'll talk about that. So 4 words we got to know. Your currency appreciates if the market's making it go up in value. It depreciates if the market's making it fall in value. It's called revaluation when the government raises the exchange rate. And it's called devaluation when the government lowers the exchange rate. So the dollar should be depreciating against the yuan. The yuan should be appreciating against the dollar. Instead, the Chinese government devalues their currency to counteract the appreciation that should be occurring. All right, so why do we care about all this? Well, let's suppose that we want to buy a car and that car costs 3 million yen in Japan. And let's also suppose that $1 equals 300 yen. If we do the math, we see that that car should cost $10,000 in the U.S., not counting transportation or whatever else. $10,000 at 300 yen a dollar would buy the 3 million yen necessary to buy that car. It's a $10,000 car. But what would happen, and what has happened, the dollar was about 300 yen to the dollar in 1970, and now it's about 100 yen to the dollar. The dollar has depreciated against the yen. It's less valuable. When the dollar's less valuable, you need more of them to buy something. So that $3 million yen car at $1 equals 100 yen is going to cost $30,000 in the United States. So the prices of goods, the prices of what we buy, are affected by exchange rates. So again, what does this mean? Import prices rise when the dollar falls. Things we buy from Japan should be getting more and more and more expensive over time. Things we buy from China should be getting more and more and more expensive over time, and we should be buying less of them. Meanwhile, our goods should be getting cheaper in China, and our goods should be getting cheaper in Japan, and folks in Japan and China should be buying more and more and more U.S. products because they're getting cheaper. If the governments of those countries don't control or manage their currency.